Financing. Financing is debt or equity that the company issues, its own debt, its own equity. So cash comes in when they borrow money. So when a company sells a bunch of its own bonds, cash comes in, and then cash goes back out again when they pay that loan back. When it comes to common stock, cash comes in when they issue common stock. Cash goes out when they pay the stockholders dividend. And remember, a company is under no obligation to buy back its own stock once it's been sold. So financing activities involve long-term liabilities and stockholders' equity items. So if you consider the balance sheet, every item on the balance sheet is covered and included in some form or other on the cash flow statement. And we've got some examples of financing activities as well. Inflows, issuing stock, issuing debt, outflows, paying dividends, and paying back long-term debt, or if a company chooses to do this, acquiring treasury stock. All right, there's a fourth category. It's not in the body of the cash flow report. It's most often found in the notes to the financial statement. For textbook exercises, we put it as an actual footnote on the cash flow statement. You rarely see it in practice as a footnote on the actual cash flow statement. Although we talk about this as being the cash flow report, we also report significant non-cash activities on the cash flow report. For example, if a company has no cash, but they need to buy assets, if they issue common stock to purchase those assets, that would go into a footnote. And there's a reason we do this, and that's because, as I just said, we use every item on the balance sheet in the cash flow report. So if there's been a swap, like these non-cash transactions, we want to account for them. Converting bonds into common stock. If you have a bunch of bonds on your balance sheet and the bondholders opt to convert them into common stock, that must be reported because, again, the bond account would go down, the common stock account would go up, and you want to explain that change. Issuing debt to purchase assets. Again, let's say a company purchased a mortgage. Let's say a company purchased a building and signed a mortgage for $1 million. The mortgage payable would go up $1 million, the building would go up $1 million, and you want to explain that significant difference. And any sort of plant asset exchanges. For international financial reporting standards, non-cash items must be reported in the notes as well. Okay, so the cash flow report is all about cash. The rest of everything you've learned in this course is all about accrual accounting. And so we kind of unpack the accrual accounting in this chapter, and we really focus only on those pieces of the entries that relate to cash. And that's what the cash flow report is for, is to record the detail of the cash transaction. So we actually convert accrual accounting into cash accounting. Now there's two ways to do it, the direct cash flow statement and the indirect cash flow statement. The direct cash flow statement is more complicated. You look at each item on the income statement, you look at each journal entry in the general ledger. The indirect statement is done more by an adjustment method, and it is considered quicker. It is also the main reason companies prefer the indirect method is because it gives away less information about the company, and it allows them to keep private aspects of their business. So the only thing you really need to know about the direct method is it gives away too much information. So why do we care about cash if so much of what we focus on in accounting is accrual accounting? Because everybody wants to know where the company stands with regards to its cash. Cash makes the difference between meeting payroll and not meeting payroll. In other words, can you pay your employees when the payday comes? Cash makes a difference for your accounts payable suppliers. They want to know that you can pay off their short-term loans. So the statement of cash flows helps users see whether the company is able to make future cash payments, whether the company is in a position to pay dividends and meet short-term obligations. And it also tells the reader the difference between net income, which is calculated on the income statement using accrual accounting, and net cash provided by operations. Is the company strong from a cash flow point of view? And it also gives you additional information about what the company is doing in investing and financing. I always tell students, I say, look at the investing. And here's an example. You have these three subtotals: operations, investing, and financing. And I always tell students, look at this number, 10,000. It's shown as a negative. That means they spent money. That's a good sign. If a company is in a position to purchase equipment, that means they're using current equipment as of this year. You want to go work for a company that's buying current equipment, that's using current computers, current software. You want to understand the most current equipment, software, technology that you can, because you may not be able to guarantee that you'll be able to work at that company forever. But if you can keep your skills absolutely up to date, that will make you a more valuable employee to the current company you work for and to future companies. So you will see cash outflows on the cash flow report are shown as negative. Cash inflows are shown as positive. So real quickly, you can see cash came in from financing, $35,000. It was spent, part of it, on investing in equipment, and cash generated by operations was $9,000. The net increase in cash was $34,000. Cash at the beginning of the period was zero. As a matter of fact, this company started up this year, so of course their beginning balance would be zero. So cash at the end of the period is $34,000. And here is your footnote: issued bonds payable to purchase land, $130,000. That ends part one. Let's go on to part two.